Welcome to the Trick Trades trading crash course. Basically, I'm going to be taking a brand new bare bones beginner trader and I'm going to be going through everything. I'm going to go over charts, what a daily chart is, your intraday chart, what a candlestick is. We're going to even talk about how to enter into a trade with options and stock. We're going to talk about going long. We're going to talk about going short. We're going to cover everything. We're going to go over entries charts so then you guys are aware when you either first start trading or you come into Trick Trades that you're going to be right up to speed by the end of this video. So I'm glad you guys are here. Let's rock and roll. Okay, so first off, I think we should start with charts. Let's start there. So I'm going to take you into the one chart, what I call one chart. And what this is we have the daily chart on the left in blue and then the 1 minute chart in black. Okay, now I'm going to split them a little bit more just so then we can see them a little bit better for you guys. So one sec, let me get all this pulled back so then you guys can see it a little bit better. So let's start with the daily chart. And I can't erase these levels because I haven't done my trade recap yet. So I'm doing this prior to the trade recap. So here we go. So this blue chart, this is what I consider our Bible, the daily chart. This is where the vast majority of traders are going to find their plays, their technical support and resistance levels, which I will go over here in a minute. But each one of these candles, and I'm going to zoom in for you, and this is a candlestick. So each one of these bars, that's a candlestick. And I'm going to get zoomed in really close now. So then we can go over first candlestick. So I'm just going to zoom in and stretch these candlesticks out so then I can explain. So let's talk about a green candle first, okay? So this green candle right here has the open, low, high, and close of the day. That's how much information is in this candle. So I'm going to zoom in even more so that I can really dissect these candles for you guys, okay? And we're going to be specifically talking about this green candle here and this red candle here because the rest are just variations. So right here on a green candle, this line right here, that is the opening price. So once the market opens, it records the price. That is the open, okay? Now let's talk about the close. I'll refer to it as the previous close a lot. And this right here is the close. And then the following morning, this would be called the previous close. So this is the close of the market. Now we also have low of day, which is obviously represented by this. Okay. And then we have high of day, which is this little top here. These lines on the candle are called wicks. The main solid part of the candle is called the body. Okay, so let me erase that. So that is a green candle. A red candle is a little bit different. The open is here up top because it opens and drops off, right? That's how it's red. This here is the close or the previous close the following day. This here is high of day. This here is low of day. The total range on the day, meaning how much it moved in total from highs to lows or lows to highs, represents the low of this wick to the top of this wick. So those are candles, okay? That's just a basic candle. Now let's talk about a gap or a gap fill. This is getting a little bit ahead, but it's right here, so I want to point it out. So where we opened up this next day, which is right here, a lot of times we will look for a play called a gap fill. So if it would have opened up, market would have opened, and it started selling off, and it came into the previous close, that is called a gap fill. It filled this gap. That's all it is. So a lot of the terminology is very basic and common sense once you kind of know what it is, right? It's not that difficult. We just need to remember these things. And remember, it is like learning a new language. So that would be a gap from the opening price down, and then it filled the gap if this body of the candle was solid, right, all the way down. So that is a candle, just candle basics. And there's a lot to candles, but this is what we're going to cover for today. Now we need to learn what support and resistance levels are. So if we are going to open up here, right, where we opened there, our trade plan the following day, we would have numerous levels that we could watch. So because we open here, we are looking for support, and support is below the current action. So if we open here, our support level is here, and then I can do one better, and a level up top would be resistance. So down below is support, up top here is resistance. So market opens up, it can do one of two things. Either it's going to come into resistance or it is going to come down into support. And there is a trade here and a trade here. But going back into the daily chart, this is where we get our levels. So from the previous day, we would watch the previous close level, low of day, the open, and high of day. Those would be our main levels from the previous day, okay? So that's the open, low, high, close of a daily candle is very important to what we do. Now, there's lots of other resistance levels and support levels. Oops, sorry about that, guys. But those are our basic ones, okay? Now, there are two other support and resistance levels that we use. Now, there is trend, and I'll go over that here in a minute. And then there are moving averages. Those are both still technical support and resistance. So let's talk about moving averages. And I'm not going to go in depth. I've got tons of videos on moving averages. You see all these colored lines? These are moving averages. The pink is the 9 EMA. This browny orange color, that is the 5 EMA. The yellow is the 100 SMA. The red up top is the 200 SMA. The purple is the 50, and the gray is the 20 SMAs. Okay? Now, don't worry. You don't need to fill your head with all of that right now. I'm just letting you know what these are. Now let's talk about trend. So I'll pull this chart back, and we'll find a trend together. Okay? So trend is something that you can generally pick up with your eye, okay? So I'm going to draw it right here. You see how your eye pulls to that? You see the high here, this range high here, high, high, high of those candles. And you see when you connect the dots, how it makes that sloped level? That is a trend. And trend is really important. So if we were to draw out this trend, let me turn on my magnet. You see how multiple touches? Now, if I were to zoom in a little bit here, you see how many times from there to there to there to there, and then into here, it touched, right? And you can mess with these trend levels, but that is resistance. So when we're below that, that's resistance. We can short that level. And I'll talk about shorting here in a minute. But that's how we use trend. Trend is really important, okay? And I use multiple different trends, and you'll learn that as you go. So that's the daily chart. That's just daily chart basics. And I'm going to get zoomed in just like I did on the daily chart. So then you can really see these candles. It's the exact same thing as the daily chart. Each one of these candles, it's just the time frame is different. Each one of these candlesticks represents 1 full minute, 60 full seconds of action. That's what it is recording. And just like on a green candle, the open is here, the close is here, the high is here, and the low is here. And on a red candle, we'll go right here. This is the open, this is the close, this is highs, and this is lows. Very simple. Okay? So now let's talk about going long and going short. This is a resistance level, and this is our support level. We want to short this level and long this level. Okay? So an easy way to remember it is above support, we go long into support. Below resistance, we will short resistance. Okay? So above support, long support. Below resistance, short resistance. It's just like, when we open up, because we opened up here, it pops, comes into this level. And by pop, I just mean comes up. It just comes up into that level. And I sometimes will refer to this, depending on the situation, as a head bump. That's not a head bump, but the reason why you'll hear me say that is because it's physically support and resistance levels. You have to look at them like they are physical brick walls, okay? And the stronger the support or resistance level, it's like having a cardboard wall, a plaster wall, a cement wall, and then a like a concrete wall, and then a steel wall. Okay, more support, so more levels that line up on the daily chart. Let's take a look at this daily chart yet again. If we look at resistance, you see all of this resistance, and you could even go back over here. See the high, 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 high? You see how it came racing on up? And sure, it broke that level by a little bit, but it's going to come into that resistance. So why does support and resistance work? Same thing with all of, let me redo that. You see all this support here? How it bounced, 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 bounced. It held that level. So why does support and resistance work? And this is really important, so then it gives you confidence in these trades. Each one of these times that it bounces and it creates a level, right? Right here, right here, right here, and right here. You're going to have people working longer positions, bigger positions, like trades, whether it be for an investment or whatever. They will protect. And every time it comes into that price point, let's say this level here, we'll disregard this 196, and let's say it is at $2. That's the price point on the chart. Every time it comes into $2, people will buy. They will accumulate and protect their position. And the reason why that works is because if you have someone that is trading a very large account, like investors, hedge funds, banks, if they are working a position at that price point, they will continuously buy it to protect it, because they're not just putting in a couple of shares. They're putting in hundreds of thousands of shares, if not millions of shares, at that $2 price point. So when it comes into that volume, which is represented down here, okay, this is all volume. This is how many shares are traded on a day. And then on the 1 minute, how many shares are traded on the 1 minute, okay? So that's a lot of shares, 80 million, 100 million, 200 million shares. So depending on the level, you're going to have more volume at support, and they are buying the position that they were already in. They're protecting the position, right? And same with resistance. So if you went long here, like you bought that, so you bought that position right here. When it comes up, because it has already told you something, it's already rejected this price point. This, we'll call it $5. $5 price point. Okay, let's say that that's what that level is at $5. From $2 to $5, they are going to sell into that resistance because, and I got to clear all this up because I want to show you guys something. So let's say, for the sake of argument here and example, this level here and this level here. This is support. This is resistance. This is, let's say it is, it isn't, but let's say that's the support level and that's the resistance level. So as it comes into this support level, they're going to buy it, which causes it to come up. Now, let's say it kept coming up. The odds of this flying up in one fell swoop and continuing up with not bumping its head, remember, it's bumping its head into that physical brick wall of resistance and pulling back, is very nil. It's not going to just keep going. We need a catalyst. And a catalyst refers to a news event, news, numbers, data, something big, in order for it to keep coming up without having at least a first reaction, which is a bump of the head, a pullback into that level. So, which also causes them to sell, which causes the actual pullback. That's what causes the pullback. People that were long here, they bought here, they are going to sell here. It's the old saying of buy low, sell high. Well, this level here is the low, and this level here is the high. So you buy low, sell high, right? So when you buy it, it's going to come up. You're going to have hundreds of thousands of traders in it buying that stock. It's going to cause it to go up. Now, when you come into this resistance at the high, they are going to sell it because it has hit their target. Professional traders use targets, which causes it to pull back. And then it'll bounce and come back up and test and do whatever it wants to do. But that's why support and resistance works. Okay? So that is talking more so about a long position. Let's talk about a short position. I'm going to pull this over to a blank chart. We have two levels. We have our support level, and then we have our resistance level. This line I'm going to draw represents on this side, so the left-hand side of this level, or this line coming up and down, is pre-market action. To the right of it is regular hours. So before I go on, let me discuss pre-market. Pre-market is generally lower volume. Pre-market opens up. So pre-market trading opens up at 4 a.m. and goes until 9:29:59. 9:30 a.m. hits, the stock market opens, and that is called regular hours. Okay? So now let's say the pre-market action was coming up and coming down and coming up, and then it comes into here. Market's about to open up, right? So market opens up. It can do one of two things. It is either going to come up into resistance or come down into support. If we only went long, if we only bought stocks or options, you're only taking advantage and exploiting 50% of the possible trades out there. Okay? So there is a way to make money when the stock goes down or it pulls back. Doesn't always need to come up. Okay? So let's talk about traditional shorting now. Market opens up and it pops. First directional pick is up, and it starts making its way up into this resistance level. As it comes into this level, we can do what is called going short, or short the stock. Now, when you trade penny stocks, really low price stocks, you need to borrow shares. Well, no matter what, you need to borrow shares, and I'll explain why. This is going to sound a little complicated, but try not to get lost in your own mind with it. And it's a lot easier than it sounds, okay? So as it comes up, you can basically reserve shares to short. You have to basically borrow shares from someone, an institution, that is already in that position, okay? Now, we don't physically go out and try and call people to borrow these shares. It's all done in your broker. It's very easy. So when it comes up, we don't buy here. If we came over to this, let's use this upper So let's say we had 100 shares that we wanted to like go short right here, because we know that this is heavy resistance and we want to bring it down into support. We want it to come all the way down here. This is our target, right? Down here is our target for our trade. When it comes up into that level, instead of hitting buy, you would hit sell or short, depending on your broker. So what you have to do instead of buy, you sell. You sell it, and it does it all automatically. That's how you short, okay? So going short, we sell 100 shares. So I would click the button short or sell, depending on broker. And then as it comes down, we obviously don't hit sell again, because then we would just be shorting more shares. We need to buy it back. Someone will then buy those shares back at that price point, okay? And then that's how you make money. So if you came down from here at 214 and you shorted 214 on Apple and you bought them back here, you covered your position at 213, we'll call it 213 for easy math, you made 1 point per share, okay? 1 point, $1 per share. That's what a point is. 1 point represents $1. So $1 per share. And because you have 100 shares, that equals $100. That's what you made on that position. So 100 shares times $1 of profit equals $100. Okay, and that's how you would make it down to here. All the way down to here is to 211. So that's 3 points per share. You could make a total of $300, but that would be holding the full position from here all the way down, which you cannot do. You have to sell or buy back, press buy to buy back that position on the way back down. Okay, I know that sounds super complicated. I know it does. But now let's talk about options, because I did tell you we're going to talk options and we are going to talk stock. Exact same trade setup, okay? Here's where it's a little different. You see our price point here is at 214 and change. So we would want to find Apple. Let me switch over to Apple just to make it nice and easy. And then we need to find the 214 or closest puts. So right here, we have two options, the 212.50s or the 215s. Well, the 212.50s are way down here. You don't want to do that. You always want to err on the side of caution. So I would go with the 215s. So as it comes up, same thing here, guys. As it comes up into this level, we would have the 215s already loaded. And we, with options, one contract, one equals 100 shares. So you can't be plugging in 100. That is a huge position for a new trader, okay? So let's use 3 contracts. Doesn't sound like a lot, does it? So as it comes up into this level, instead of selling, we're not shorting here, okay? We are buying puts. And a put, and I'll talk about calls in a second, is just options terminology to basically go short, but you don't sell, you buy. You buy a put. When you buy these 3 puts, as it comes down, if it came all the way to this target from here to here, which is about 3 points, you're probably looking at, and this is the beautiful thing about options and the way I trade them, you're probably looking at about 50 to 75% return on investment. So instead of points per share, we get percentage gains. So 3 contracts, a very small 3 contract position, could easily make you over $1,000. Easily. In this specific trade example, okay? That's just this example. And that's not a claim. That is what it is, okay? So again, I'm going to erase this because I want to be very thorough and very clear so that everyone understands. We have our 215 puts ready, and we have 3 loaded in where my cursor is here. Market opens up, it starts coming up. As it comes up into this level, we execute by buying those 215 puts. And then as it comes down, let's say we want to sell here, we would hit sell. Okay, I know it says short there, but I'm not in a position. You just sell it. Now, let's talk about calls. Calls are on the left-hand side here, okay? So if our area of execution is right here at 211, 210, let's take a look at what we have. So we have the 210s and then the 212.50s. So our level is 211, and we have the 210s. I would err on the side of caution and go with the 210s. Why? Because these stocks, as it comes down, they can come a little bit further. And when it breaks that level that you already bought those calls, those contracts, it will melt down. Okay? Meaning you're going to, the red in the position is going to accumulate. You will be negative money on that position. Okay? But let's just talk about just a straight. So we have our 210 calls. Again, let's say this one's really good, so we go with 4 contracts. Market opens up, it comes down. As it comes into that level right there, we would hit buy, and we would buy the 210 calls. And then as it comes up, maybe you have targets here, here, and then ultimately here, and you have 4 contracts. The first one here, when it comes into that target, you would change this to 2, hit sell, pulls back, keeps coming up, comes into our next target here. We want to take 1 off there. You hit sell, and then as it comes up here into our final level, we have 1 contract left, and you would hit sell. So that's what going short, buying puts, going long, and buying calls is. Okay? That's all it is. It's not overly complicated. It's just new lingo and new language. Okay? This thing right here, that is an options chain. Okay? That's what that is. And again, the puts are on the right-hand side and the calls are on the left-hand side. These are different expiries. We always use closest expiry. That's it. Nothing complicated, okay? And it'll always be on that. Now let's talk about what this is. What is this? That is a level 2. Level 2 and order manager, okay? That's where you, on the left is the bid, on the right is the ask. That's just orders that are out there, guys. I always mark it in. I don't use limit orders. So I'm not going to explain all of that because I highly recommend, especially with the size you guys are trading, you don't have to worry about slippage or anything like that. I've been trading with huge size and I do not get slippage. Why? Because I'm trading proper stocks. So I go market, which is what all these letters right here represents. It just means smart market. And that's where I buy and sell. And this is the bid on the left. And on the right is the ask. Those are buyers and sellers. Those are all of your orders that are out there. This is the price point here. So first, on the far left, those are the different exchanges. The price point here is the actual price that they're buying and selling. And these numbers here, you're going to see 5, 8, 4, 3. You add 2 zeros to that. Okay? So this one here, this 11, is pretty big. That's 1,100 calls, which is a big position. That's a really big position. Okay? So that's all that is. Now let's talk about this chart here and why I have it up. I have it anchored to the position my options position that I am trading. So I'm going to wheel this out, and you're going to see some arrows on this. So this was my trade from today. So let's go over to SPY. So this happened up top. It's going to be opposite, right? Because it's coming down, and these are puts right in here. So as it came up, I'm going short, and that is the entry here in blue. And all of these red, that's where I sold. And then this is a long. So this is a little easier to explain just for like our purposes here. So the very first position I took, market opens up and it sells off here and bounces. You see these two blue triangles? I bought here, bought here. It came up. I made money and started selling on the way up here. Then, as it came back down into my support level, I worked my position. So it came lower than expected, which happens, but I have a contingency plan. So I started there, added there, and it's well within my risk tolerance here. It's not that far. I have this really stretched out. It's really not that far. It's less than a point per share, okay? So then, once it came back up to test resistance, I got out, and that's my sells there. So I still made a little bit of money on that position, even though it didn't work. But I want to point out what entries charts are. This here down below is your positions with your closed positions. This is your P&L, your profit and loss on the day. This is the positions that I took. This is my realized profit. It was very small due to working with live trading members here today, which is a course that I also run. And that's that. For the last little bit, I'm going to explain some of the terminology that I use on certain setups that are kind of proprietary to me and Trick Trades and what we do. So I'm going to use different terminology, but I'm going to explain a couple of them just so then you guys understand. So let's talk about trend formation. So I'm going to draw out here resistance, support, pre-market, regular hours, and we are going to open up in here. So pre-market, we're about to open up. It's 9:30. Market opens up, and we want to go short up here into that resistance. Like maybe we're up at highs. It's like a perfect shorting opportunity. We really want to capture the short. And we still have a lot of distance into the short and into the long area. Okay, so there's a lot of distance there. So normally, like I've said before in this video, we want to go short on a pop up and a run up into that resistance. But what if that doesn't happen, but we still want to capture the short? Well, trend formation is the way to do that. So with trend formation, market opens up and it washes instead of pops, right? Well, you can't chase this down. You can't just go short because you want to go short and you are expecting this stock to go down. You need to wait for the right setup. And what I've come up with of something through the years that I've noticed, it's called trend formation, or at least I call it trend formation. And it washes at the open. It can even, and I do want to give you guys a couple of different scenarios. It can even pop up a little bit, but it doesn't come anywhere near into that resistance. So it can either pop up a little bit or wash out. So we'll use the pop up and then it washes. So I want to explain this step by step. This is a high. We have a low. So in typical technical analysis and chart setup fashion, we want to look for a lower high, as I covered before. So when it comes back up and it starts to roll, okay, it just starts to slow down. The action starts to slow down. This is an area where we can get involved with the short. And I want to explain why we can do this. So let's say we're way up high at the top of a range. We know we want to be going short. And a lot of the times that'll happen after that final push. Sellers are going to step in, and it's not going to have enough buying pressure in order for it to come up into that resistance level. So if it washes out, pops back up, we can then execute that short. Risk off of high of that range from the morning, or possibly there is a pre-market high in that area as well. So we execute the short. As it comes down, you pay yourself into first level of natural. What I call first level of natural is first level of support. That's all that means. And then you want to see it continue, make a low, and then a lower low. As it comes back up, there is opportunity to add in. You could, and remember, this is not a full-blown lesson in trend formation. There's a lot more to this, but I want to give you the idea of trend formation. So what we have here, if I were to draw a trend, we have a trend there. So the idea and how this came about is there's always a beginning. There's always like a beginning point to where a trend is formed or any chart setup is formed, right? Hence the name trend formation. So going over that just quickly one more time, I don't want to be redundant, but I do want to make sure that you get this. And we'll do the secondary example with the market opens up and it washes. It washes. And remember, we want the short, but there's no way to capture that short. So when it comes back up, you can then, as it starts to roll over, you can execute that short and simply risk off pre-market highs or where it opened. Okay, right in that area, a technical range. And like I said, it's about the beginning of it. That is right at the beginning of the trend being formed, hence trend formation. Okay, so that's trend formation in a nutshell. There's obviously more to it than just that, but that gives you an idea of what I'm talking about when I'm talking about trend formation. So the next one that I want to talk about is a head bump. Okay. Now, from the previous lessons, as I've stated, when you are above support, you go long into support, no matter what. That's strategy. And one of the reasons why a lot of traders fail is because they let their feelings or they say things like, oh, it looked like it wasn't going to hold, so I didn't take that. You can't do that. That's nonsense. That's bullshit. That's not strategy. So what you do and what you can do is no matter what, you execute that long. Even if you think it's not going to hold. I don't care. I don't care about what you think. None of that. It's irrelevant in the world of trading. This is strategy. It's pure strategy. So you execute that long. And if it fails, like you were led to believe for whatever reason, and it washes through, that's okay. Because what you do then to manage the trade, you add into that wash, you get out fully on the retracement. Now, as technical traders, when you're really new, you don't have the experience under your belt to understand that this is what will happen next. 99 times out of 100, okay? So when it washes through that support level, it needs to retest that former support, now proving resistance. And as I've spoken about before in this, these are physical brick walls. And it's like jumping up into a ceiling above your head. You're simply looking for the head bump. All it is a technical retest or test of former support. Now it's testing as resistance. And whatever the odds are of it working, it is high because there will always be a first reaction. Always. Anytime you hit or touch a technical support or resistance level, you will, with a capital WILL, it will have a reaction. I don't know how big of a reaction, but there always is a reaction into a valid technical support or resistance level. And that's what we're trying to exploit. We're trying to capitalize on that. So again, market opens up, it washes into support. Even if you don't want to take that trade long, doesn't matter. You execute. If it washes, that's fine. We add into the wash. And like I said, it will retrace coming back up. And as long as you're adding into that, where you start here, add here, your average is here. And I'm going to cover averages here in about two seconds. And then you simply would get out of the long into your target of that former support, now testing as resistance. Above, we are support. Below level, we are resistance. It bumps its head. You get rid of that position on the long, and then you go short or you buy puts. And you will at least get it down to here. Why? Because it has to test support. It's always a complete circle and a cycle of testing support, then testing resistance, testing support, then testing resistance. Unless there's a catalyst or the action is really wonky, you're going to get that. And that's what we bet on and that we can capitalize as traders. Okay, so now let's quickly talk about averaging. Now I can do a whole video on averaging, but this is going to give you the idea of it. Okay, so same setup. Let's say our support level is here, resistance level is here, and this right here is our stop, our risk. Okay? So market opens up, it washes and comes down. Washes means it starts coming down. As it comes into the level, you start in here. Let's say we're working with 10 contracts or 10 shares, doesn't matter, but we'll call it 10 contracts, okay? So you start in, and we'll keep it real simple. We'll go 5 and 5. So you start in with 5 contracts. Your first entry is 5 contracts, and let's say your price point, we're not looking at these price points. Let's say your price point is $1. Okay. You start in there at $1. It washes and continues into your risk. As per protocol and strategy, you add into your risk, or another technical level, you add 5. Well, if you started in at $1 and this is all the way down here at, let's say, 50 cents, which that would be a big wash, and we're not using that much risk. I'm just trying to use some real easy numbers, okay? So your average, if you started in at $1, added in at 50, and it's exactly 5 contracts and 5 contracts, your average is split down the middle. Well, what is that? Well, that's 25 above and 25 below, meaning 75. Your average is now 75 cents. So when it comes up back into here where you entered, you are flush, and it comes into this level as a retest, because if it failed support, it will retest as resistance. You will be up roughly 25 cents. Now remember, these numbers that I'm using, your average is going to be different, but I just wanted to give you the idea as to why you average and add into these trades. You need to keep that average tight, and your average is going to be right here. So if you look to the bottom right-hand side of this screen, you're going to see where it says average cost. That's important. You need to know where your average is. And I'm going to clean all this up, and I'm going to tell you what will happen if you don't add or average in. Market opens up, it washes here into the level, and you start in with, let's say you work with a full 10 contracts, your maximum position. Then as it comes down into your risk, which is a technical risk level usually, when it comes back up, you need to get out of this. Well, you're break even, you're $0, right? maybe positive a little bit, maybe negative a little bit, but overall you are flush, you are even. It is break even, right? So what happens now if when you start in here with a full 10 contracts and it washes all the way down and comes back up to just not quite that level? Well, you're negative, right? If you would have added here, your halfway point is here, and you would be still green on a failed trade. And that's the kicker. That's the reason. We do what we do, and there's tons of trades that I take that are failed trades. They didn't work. They didn't work, but yet I am still green. And that is due to management. This right here with adding and averaging is an introduction to trade management. It's not so much about trading. It's not so much about what you think trading is about. All that matters is the management of that position, how you control that position. That's the important part. Now, obviously, that is a lesson for another time. We can't go into that because it's a lesson in itself. But you understand the concept now of adding and averaging. So I think that about covers it for a beginner's crash course. And yes, of course, there is a ton of other information that you guys could be looking for in this video. That's why I have hundreds of video lessons at Trick Trades, as well as almost 1,000 free video lessons on YouTube. This is why I do what I do, because I love doing what I do and I want to see you guys succeed. So with all that said, if you want to become a professional trader, come to tricktrades.com. If not, continue on with the free stuff over at YouTube. Just keep in mind, no matter whose free stuff it is, it's just going to take you a lot longer. That's how it is. And if not, if you're really serious about this, come to tricktrades.com. Okay, folks, I hope you enjoyed this. I would recommend watching this a few times so to let it soak in. We'll catch you next time. Adios.